almost 24 hours, and but we're very happy to be here, and very happy to be in Sydney. It's a very impressive city, a very lively city, and we're enjoying ourselves. Took the Big Red bus over the weekend and saw quite a lot of stuff. What went around the Opera House, very, very impressive. So what we'll talk about, basically is risk profiling, mostly insurance companies and pension funds, but in some ways I think the procedures and the processes could actually be extended to other financial institutions, and I think David has worked a lot in capital markets, and he'll talk more about what he has done. Risk registers and systems dynamics, and I'll leave that to David. He's more of the theoretician. So when it comes to regulators, what do they do? How do they operate? And one of the most important issues is risk profiling, trying to classify insurance companies into greater or lesser risk. So we have this risk-based approach, rather than giving all the companies equal time, which we used to do when we used to make sure that they complied with the regulations and so on and so forth. And we discovered that, we could have companies that are complying completely with all the regulations and still go bankrupt. We have one life company in Canada that was AAA rated right until the very day that they went into liquidation. So, as they say, I can't remember, it was Mr. McCorber or somebody who said, how did you go bankrupt? Well, at first very slowly, and then suddenly. So, so what was wrong? What were we doing wrong? And so, we realized that we needed to move towards a risk-based approach to spend more time on those companies that keep us awake at night, and, just keep a watching brief on the ones that we're confident are well run, and so on and so forth. So how do we do this? Well, we have a series of quantitative and qualitative judgments, and really on a forward-looking basis. I think what used to happen is we looked to the past. You've probably heard about this wonderful analogy of the insurance company with the CEO at the wheel and the marketing manager with his foot on the accelerator, the gas pedal, the controller, with his foot on the brake, and then the actuary looking out the back window, yelling at everybody else, telling them where to go. And to some extent, regulators used to be the same. They were looking out the back window. They looked at forms that were filled out, 3 months prior about the previous year, and made judgments about that. Well, that doesn't work. You have to make judgments about the future, and that means looking at certain quantitative measures, are very, very useful, but also qualitative judgments. So that makes life a little bit more difficult. So we combine those to create a supervisory attention index. So so then that will help us to schedule our inspections and drafting of remedial plans and so on and so forth. It will indicate if there are things going wrong, it'll indicate what's going wrong. So that's very helpful. And really the idea is to spot problems before they occur and remediate them the best we can. That's because the regulator is in a very paradoxical situation. If there is a company that's in difficulty, they obviously don't want customers to carry on pouring good money after bad. But if they tell everybody, if they're transparent, and this is really the difficulty of being very transparent as a regulator, if they're transparent, then of course that's a death certificate for that company. Once we sort of say, hey, don't put any more money in that company because it's going down the tubes, then it's going to go down the tubes, even if it was rescuable. So spotting the problems beforehand and remediating them, that doesn't necessarily solve, but it mitigates that particular problem. So I'm going to show you this matrix that David and I have developed that, as I say, mostly insurance and pensions, but I think can be applied elsewhere. And I won't go through it. I would suggest you look at it, and my eyes aren't really good enough to see exactly what's there. But there's about 9 different categories, from things like governance, obviously extremely important, risk management, and and then, we go on to the financial condition. So then, that includes things like actuarial valuations and in case of, say, property and casualty company, all the risk ratios and so on and so forth. And then, we look at various risk things like the underwriting risk and then the investment risk. And the strategic risk and customers and so on and so forth. So I, encourage you to have a look at all of those things. I think, there's nothing really new there. I think we know, what all those risks are. So again, it's sort of an analysis and then trying to put everything together. And, it's a neat little spreadsheet. And I thank David for it, really, because he's a lot better at Excel than I am. I can sort of, add up a column of figures, basically. And so, you can then you score these companies as high, medium, and low, and so on and so forth. I guess the question is, where do you get this? Where do you get the data from? Yeah, and I think we saw that wonderful, and I've seen that before. I think where you start off with data and you go to information, and then that's distilled into knowledge, and then finally wisdom. I don't know about wisdom, but certainly I usually stop at knowledge. But so so where do we get this data from? Well, obviously there's a lot of regular filings. There's also the on-site inspections and so on and so forth. So, one approach, it depends on how the regulator wants to work, but one approach is to actually get the companies to fill this in. You can either sort of take the data that you have, and then, or else you can say fill it in, and then the regulator then would have to be sure that the people are truthful. I think, funnily enough, you think, well, everybody's going to say, excellent, excellent. People actually tend to be rather pessimistic about their own operations. I remember, with the Institute of Actuaries in Canada, one time decided to ask people, they have all these norms and standards and so on, and, nobody ever knew whether the actuaries were actually following them. They said, well, let's send out a questionnaire and ask people if they're following all the norms. And so they got back, about half of them, they said, no, we're not. What do you mean you're not following the norms? What do you mean? Well, we've got these whole policies. We've got 5 of them in the books. It's too complicated to actually calculate the reserves, so we take an unearned premium reserve, or we take the full sum insured as a reserve or something like that. So we're not following. So the institute said, well, look, think about materiality. So in fact, these people were more honest than they really ought to have been, to realize, that materiality is important here. So you'd be surprised at how people actually admit that they're not doing things properly. But still, obviously, you'd have to check that. Or you obtain the data through various means. Certainly the on-site inspection is a very, very powerful tool to make sure that people do actually have the policies that they say they have, and they're implementing the policies and monitoring the policies and so on and so forth, and it goes for most of the categories. What do we do with that? This is a very usual equation in insurance. It applies many, many different circumstances. That the risk to the regulator's objective is the square root of the probability, the impact of an event times the probability of that event. So this sort of puts your qualitative and quantitative analysis into a single number, a risk rating. And of course, the risk is not linear. Risk, it starts off very low, but then very quickly goes up. So that's a recognition there that the risk, it's not just a linear risk; it's an exponential risk. Impact. Normally, you think of impact in terms of size. So obviously, you're more worried about big institutions than small institutions, but and size can be measured in a number of different ways. It could be the assets, it could be a number of policyholders, number of pension plan members, and so on and so forth. But I think in some ways it's a subjective element to impact as well. Small institutions can be problematic. they can, I'll give you an example of Northern Rock. If you remember, if any UK people here remember Northern Rock, it was a mortgage lender in the UK, but it was in the north of England, and you probably know, south of England is where everything happens, and all the financial institutions are down there. All the rich people live in the south of England, and so on and so forth. But this was the north of England, and this was the pride of the north, and so on and so forth. And it was a relatively small institution compared, to, I don't know, HSBC and Lloyd's and all these other big, companies, financial institutions with their headquarters in the south. And so, that had an impact that was beyond its size. Sometimes state-owned industries or state-owned institutions and so on may be relatively small, but everybody goes bananas when something happens to a state-owned institution that they may not be quite so concerned if it's a privately owned company. So, I think while size is a key element in the impact, other things matter as well. And of course, the probability is what we get from this risk rating profile. So we combine those two to come up with this nicely coloured. Colours are very good here, and so we use that. And there's this thing where we take the risk rating and we take it to the fourth power. That's interesting, and I suppose the Australians are probably familiar with that. Why the fourth power? I don't know if it's ever anywhere explained. I think I saw it on one slide from APRA where they talk about it, and it's basically because it simulates exponential. If you look at, obviously at some point the two graphs separate, but within this range, taking it to the fourth power is very close to an exponential calculation. So, I suppose, I don't know, I'm sure the actuaries certainly wouldn't shy away from exponential, but perhaps, especially in developing markets, I think that's part of the problem, is that you're not often working with actuaries. Very few of the regulatory bodies have even one actuary, and in fact, in some countries, there are no actuaries in the whole country. So, you're looking at people, civil servants and so on and so forth, who don't necessarily have the same level of education and so on as we have in developed countries. So you've got to keep it simple, and I think, using the fourth power, it does simulate this idea of an exponential increase in risk. So here you have it, and you've got, the four quadrants. The bottom left-hand side, the green quadrant, where you say, okay, fine, we're sort of fairly happy with these people, and, we'll just give them prudential visits and so on and so forth, make sure they're keeping everything ship-shape, and then up to on the right-hand side at the top, the red area where, we really are concerned. And we really want to keep everybody out of that red area. If it's got to the red area, we're failing. And in fact, to some extent, these numbers are very helpful for assessing how the regulator is doing. How do we assess a regulator? Well, if a financial institution fails, that's a bad thing. But except in the US, where financial institutions seem to fail about, 100 to 150 banks fail every year, or in financial institutions, and that's the average. So, 100 is a good year and 200 is a bad year. That's the United States. Anywhere else in the world, I think, if one goes or two go, as has happened in Canada, then it's a big issue. So, that's sort of the life and death kind of judgment as to, whether the regulator is doing a good job or not is, it's not very helpful. So these ratings, we can look at ratings individually, we can look at ratings across the industry. And if the average rating is relatively low, that's a good thing. If the average rating is going down and over time, that's an even better thing. But, if the opposite happens, then it's not so good. So it's actually very, very useful for assessing, certainly over time, how well the regulator is doing on an industry-wide basis. So, you know, the sources of data, as I've said before, you can get quantitative data from regular filings, and that tends to be somewhat backward-looking, although, you know, obviously strength of reserves and capital and so on are very, very good indicators. And again, you know, time series, how is that doing over time? Is the capital strengthening, you know, and so on and so forth? That's good. If capital begins to go down a little bit, that's not so good. You know, I think a lot of regulators use a financial condition report. Financial condition reports, and they vary from you know, one jurisdiction to another, but a financial condition report is an extremely useful thing because, again, to some extent, depending on how you structure your financial condition report, it can be very forward-looking. We can ask people what their plans are, have they achieved their objectives, and so on and so forth. So it's in some ways a bit of a misnomer because not only financial, it should be looking into a greater scope of data than simply financial. In some cases, the only way to get stuff is through the on-site inspection. If you're going to judge the quality of governance, yes, you can look at how many board meetings they've had, how many reach quorum, and so on and so forth. That's kind of interesting, but I think to really drill down, you have to interview people, you have to talk to the actuary, talk to the auditors, and so on and so forth. And again, try to get some of the information might be confidential. You know, auditors often issue management letters which tend to be confidential, but you're the regulator, you've got to go and see them. And again, you'll find that auditors, you know, in the management letter can be quite open and candid, and so if you can get to see those, that can be very, very useful. You get a sort of an interim view by the off-site analysis if you get, you know, all of the various filings and so on and so forth, and actuarial reports and that auditors' reports and so on. So that gives you a sort of an interim score, which you can then confirm with your on-site analysis. Whoops, time's getting on. Okay, so, and if you need information as a regulator, ask for it. You know, you shouldn't be shy. So, okay, I got to kind of move on here. So I think this is, you know, this is pretty obvious that you've got these 3 or 4 different levels. So the macroprudential, and this can be useful for macroprudential supervision. So it tells you the overall level of health of the industry and so on and so forth. And so it reduces the overall. So what am I saying here? So you can, I guess so if it's reducing, if the sort of health is reducing, you know, that's not very good. And it can indicate systemic problems. So if there are scores, if all the companies are scoring particularly in a particular area, and it helps to spot the problems before they become acute and you remedy them in time. And, you know, again, as I say, this you probably can, you know, apply this more broadly. Some cases you have to sort of, you're going to get more information, less information, and so on and so forth. Many of the qualitative factors remain the same or very similar, the actuarial reports and so on and so forth. But I think the qualitative ones, often you have to, they will differ from different institutions. And I think I've gone over here, but I'm going to leave this for David to carry on. Okay, thank you very much.
Morning. Thank you very much. I'm actually based in Australia. I came down from sunny Noosa, so it was a bit chilly this morning when I got here. I'm going to talk a little bit about 2 issues. One is looking at risk registers. Emerging markets tend to follow trends that are put out by the various regulatory bodies. So, for example, in the capital markets area, we've got the IOSCO recommendations, and IOSCO will put out a paper and say everybody should have a risk register. and they'll put out a paper and say that you should have risk-based capital, or you should have proper infrastructure standards for your clearinghouses and settlement depositories. So quite often the emerging market regulators are looking for a methodology to implement what is recommended on an international standard. And one thing that I've noticed was that a lot of people were doing risk registers, but they really didn't know how to use them or what they meant. So quite often these risk registers are just a number. They're put on this matrix of colour matrix, and it says we've got a high risk. Well, what is the value of that high risk? How risky is the risk? What are the controls you've got in place? And what's your inherent risk, and what is your residual risk? And how well are you controlling the controls that you put in place? So here's a typical stock exchange risk register. It came up with hundreds of risks, lots of risks across the different parts of its operations, but it had no real way of saying what is the relative importance of this risk. And in fact, this particular one is for the Saudi Stock Exchange. I was doing some work for the Saudis, and their internal audit department, their internal audit report was basically how many high risks they had, how many medium risks and low risks. It really didn't look at, well, what are we doing about controlling these risks? So we set about to work out a methodology that we could quantify the risk in these risk registers that they had. So the first stage was that we developed a taxonomy of risks for the particular organisation. And I've done this for regulators, for exchanges, for different types of regulatory functions. And the idea is that you create a risk family so that when you get these risks across the different parts of the organisation, you can actually sum the risks and see what it is overall. And of course, you have to measure those risks in relation to what is the overall capacity of the organisation to have a risk. So we tried to do this by having a series of calculations and relate it back to the capital. So for example, in the Saudi exchange viewpoint, they had some, most probably $2.5 billion US of capital, of which we allocated about 1.5 billion as relating to covering the risks that it undertook, whether it was developing new computer systems or listing IPOs and having some reputational risk or some problem that might come out of those IPOs, etc. We wanted to calculate what was the risk in relation to their capital. So basically you can only lose your capital in a way before you go bankrupt. So we felt that the capital available for your risk was what your most serious risk should be benchmarked against. So we had methodologies for looking at the risk itself, the size, the impact, and the probability that you would have a risk. We had a look at how fast that risk might occur, whether there was some time process that you might have to actually identify this risk was occurring, or whether it could happen overnight. And then we would put this into a process of deciding, what do we need to put into a risk register so that we could calculate these risks. Once we put it into the register, we came up with this process. There's actually, the risk registers most probably got 60 columns in total, various different items that you're looking at, the controls you've got in place, etc., etc. But what we were very concerned to look at was, what is the inherent risk? What is the residual risk? What are the controls you've got in place? And what are the controls that reduce the majority of the risk? They're the controls that the internal audit people should be looking at, just not this blanket set of risks that they're considering. And then once we've done that, we can come up with a monetary value for the risks. And for example, this next one is, this is the Albanian regulator, the FSA in Albania. We did this exercise for them, and we came up and we were able to look at the risks across the organisation by area, and then look at what was the combined risks in those different areas across the whole organisation. And then they could set their planning for how they were going to monitor those risks. Now, the regulator might do this for itself. It may do this in conjunction with its stock exchange or its clearinghouse and require them to have a risk register and do these calculations. But if you go into the internet and you have a look at risk registers, the majority of them will just be, we've got high, medium and low risks. They don't actually put a value on them. And this, I felt, was a good way of being able to get the regulators to understand what is the value of the risks that they're actually looking at. The next area I wanted to talk about, which I found a little bit interesting over the years, and it's starting to get some attention, particularly got a lot of attention in during COVID, because people were building these models to look at the growth rates of COVID and the impact of COVID, etc. But system dynamics, and I know there was an earlier session at the conference I saw on the program. I wasn't here, so I haven't had a chance to view it. But the idea of system dynamic is that you have the various stocks and flows of actions that you want to consider. I developed this particular model for the Indonesian market. Indonesia, like the Australian market, has a stock exchange, a clearinghouse and a depository. The clearinghouse carries the risk of the market risk of any of their members of the clearinghouse that have got outstanding positions, and to protect against those outstanding positions, they have to have a securities guarantee fund, so they have to have a pot of money. Now, when I started this project, most probably the first time I did it was 2005, 2006, they had about $250,000 US in the pot. And we did some calculations that they should be more like, at that stage, 250 million US in the pot. So we started to build a model of the market to work out how much levy they should be putting on transactions to put into the pot. What was the likelihood of failures in the marketplace? How much would it cost them? So what was the gradual growth of their guarantee fund that they would have? And we've done this exercise 3 times, and we've been reasonably close on our calculations in doing the exercise. And then we've come up with, today, there's about 700 million US in the pot. And it's enough to cover what IOSCO BIS say is the minimum amount you should have to cover the 2 top brokers in the market if they were to fail. So what happens with these what happens with these diagrams is I use the diagrams to conceptualise what is the issue, and I don't actually use the system dynamics to do the calculations. The diagrams, once you've done the diagrams as to the relationships between the market and interest rates and number of brokers and number of clients, etc., what will be the impact on the fund, it then produces a series of equations, and I will then move those equations over into a moving.
What do you want to do?
No, I want to move
Forward.
Yeah, right. So I'll move the equations over into an Excel model, and we'll look at the various components to come out with some sort of answer with a distribution as to what the level of the fund will be at the particular time. Excel also has lots of Monte Carlo type tools, and it also has the availability of applying various distributions to the issue that you might have. What's the distribution of likely trade value? What's the distribution of failure of a broker, etc.? So you have to pick the right distribution to put into your Monte Carlo model. And then you will get a distribution of your securities guarantee fund, and you will see if it fits within your 99% confidence that you're going to have so much money in the fund to cover the risks that you have. IOSCO have got standards which say you should have enough money to cover the 2 largest brokers failing, and then from that you would look at what is the highest period of activity you've got and what is the highest volatility that you've got in the market. So in the case of Indonesia, I think the last time we looked at it, the highest values were in 2010, but the biggest volatility was in the 1998 market when it retraced 60–70%. So that was a thing. And then finally you get a chart, if you like, in the 2015 calculations at the top line there, you'll see there's 8 trillion rupiah was the requirement for the maximum risk for the 2 largest brokers. And at that stage, that would be about 600 million US. And we only had around 500 million in the pot at that time. However, in 2018, when I last did the calculations, the 2 largest brokers on a T+3 basis, and you might have heard with the world's moving to T+1, but on a T+3 basis was about 5 trillion rupiah, which was about 220 million, I think. And then the moving to T+1 was another measure we put in place that reduced the risk further down to 4 point, I can't quite read it from here, about 4.9, I think it was, or some figure like that. So there's some sort of practical ways we've been helping the regulators look at risk and applying some different sort of tools, etc. So I think that's right on time.
Oh, very good.
Okay.
I might just ask you to stay up there because of the audience online. Pretty close to time. I think to sort of frame the first question really, you've mentioned working in Saudi, in Indonesia and Albania, I think, were the 3 countries you mentioned. Could you give a bit more detail as to some of the other jurisdictions you've worked in?
Well, I think I've done over 35 countries, maybe even more. And that is as doing this regulatory work. Most of the work both Mike and I will do is for Asian Development Bank, European Bank of Reconstruction Development, World Bank, IFC, IMF. It just depends. You know, they contract out for work, we apply, and we see if we get a role. Sometimes we'll work in the same country together, or we'll work for the same officer at World Bank or what have you. So we've worked together in a number of countries. Some interesting ones for me, Mongolia was good, Ghana, Nigeria, West Africa, WAMU, which is the West African Monetary Union, all of East Africa, all of Asia. I haven't done Cambodia or Myanmar, but I've done the rest in some way. I've been involved in their markets. And sometimes it's good that you can start a project and you'll go back to those people over time. Others you might only go once or twice. I've always thought it a pity I hadn't been invited back to the Maldives the second time, but I really enjoyed going to work in a ferry, you know, not having to battle the traffic. So yeah, no, it's different processes and what have you. But working constantly, I flew back last week from Pakistan, and I'm on my most probably 10th project for the Pakistanis. They're trying to do what the Australian exchange has done and brought everything into one trading exchange and one vertically integrated operation for clearing, settlement and exchanges. And that's interesting work, and it's good to be invited back because you get to know the people and you've worked with them over time.
So more specifically, so the first question is really that risk profiling as a concept. It makes sense for a lot of jurisdictions, but what are the specific challenges in some of those economies developing?
Well, take George's country, Capital Markets Authority in Kenya. Capital Markets Authority in Kenya in 2008, I suppose it was, had 5 stockbrokers failed. And if you went round Nairobi after those events occurred, there were lines and lines of people lining up at the brokerages trying to get their money back. I've seen in some jurisdictions where the people actually throw stones and riot at the stock exchange, etc. And that can happen in developed markets as well. You know, there was quite a riot outside the Hong Kong Stock Exchange and regulator after the mini bond crisis in 98. So you can have investors can get very irate. So the problem with Kenya was they had all these brokers failed. If you picked up the files and looked at the files, all the red flags were there. Right? Everything was there. You know, the guy hadn't been paying his creditors, customers have been complaining, etc. So it was a matter of actually getting some sense of purpose to gather, as Mike said, gather the information, analyse it, provide a risk calculator type process so that they could then undertake that. And we put in risk-based capital, we increased the capital requirements for brokers quite substantially. And they haven't had a failure since they put in the process. And they've been quite a, I suppose, poster child for the emerging markets has been Kenya, both on the pension side where Mike did a lot of work on the IRB.
The Retirement Benefit Authority.
Yeah, Retirement Benefit Authority. And I work with the Capital Markets Authority. And they're now going to other countries and helping capacity build. So, for example, I've been doing some work in Ghana, and the Kenyans have been across to do some capacity building for Ghana. So, yeah, they have to start somewhere. You have to get them to get into the analytics a bit and organise themselves so that they can find out these risks.
Yeah, if I could just add is that working? If I could just add something to that. I have one rule about regulators, that is, don't have windowsills. Because, you know, you go to a regulator, as in Kenya, and the windowsills are full of files. They're files, and this is a kind of old-fashioned way of doing stuff. You get all sorts of regulatory filing, much of it actually useless, and, you know, just, you know, some of those numbers. I mean, I would fill in one of these. I could fill one of these things in with random numbers, and nobody would be able to notice. So, you know, and so there's all these papers there, and some of those files could in fact contain red flags. And yet, if they're sitting there on the windowsill waiting for somebody to get to them, by which time 1 year, 2 years have gone by, that's a risk for the regulator. If, as David says, you look at, you know, the files, you look at, you know, what's there, and you say, oh, should have noticed that, then, you know, I believe in Australia they fired the whole of the insurance regulators before APRA. And APRA is a result of people, you know, not looking or not seeing red flags as they occurred. So, you know, that was my number one rule: don't have windowsills. In other words, don't let these files pile up. And if, you know, you're getting a whole bunch of useless information, stop it. Get useful information that, you know, you can summarize into, you know, you know, not necessarily one number, but you can summarize. And then, you know, make sure you look at everything that comes in, because there could be a golden nugget there that you're overlooking. So, you know, it sounds silly, but I guess that's my number one criterion: don't have windowsills, especially in Kenya. Sorry if I'm picking on your country.
You'll get a chance to sort of reply in a moment. Another question is how do you advise regulators in emerging markets in addressing slowly developing risks when often the priority will be more immediate risks?
Okay.
Yeah, I think, one of the things regulators have tended, and I guess this is changing now, but have tended to look at idiosyncratic risk in each particular company. They look at one particular company and say it's good, bad, or indifferent, but they don't necessarily look at systemic risks. And I think maybe that's what you're talking about, sort of slowly developing risks, a systemic risk, something that is happening throughout the industry, in fact, throughout the economy, which maybe the regulators can't do very much about. But I think, one thing is to try to get the regulators to worry more about macro-prudential risks, and I think that's happening. Certainly happening in developed countries. But, a while back anyway, the regulator was focusing really on each individual company. But you have to, or each individual pension fund and so on, but you have to get them to focus more on, you've got, we talk about bad apples in the barrel. If the barrel is rotting, it doesn't matter whether the apples are good or not, they're all going to fall out. So, look at, try to get them to understand the macro-prudential issues, and and maybe it means having a conversation with not necessarily the regulator, but with the government and with civil servants and so on and so forth. And can be difficult. Insurance regulators are not the sort of highest profile people in the country. The central bank is, and some regulators are in the central bank. You find that there's every kind of organisation out there. And in some cases, you'll find that the regulator is actually part of the central bank. And that can be helpful in that, that they have a little bit of an input into the central bank. But if not, the regulator is not, the pension and insurance regulator are not necessarily the highest priority people. So somehow they've got to put themselves forward a little bit towards the powers that be and the politicians to say, look, you've got to fix this, and you've got to fix that, and so on. Legislation often lags behind, regulation lags behind. It's, it's often not fit for purpose. You go to Indonesia and you find banking regulation is based on the American model, pension regulation is based on the Canadian model, insurance regulation, I can't remember, but it depends on which consultants were there. That shouldn't happen. It should depend on what's needed in the company, not, whether you happen to send an Australian, I guess it's Australian, whether you happen to send an Australian or a Canadian or American or, or a German or whatever. So I think, I don't know if I answer your question, but I think that's, get them to concentrate on the macro-prudential elements as well, fix up the system before you start worrying about, individual companies.
That wasn't the question verbatim, but I think hopefully that answers the question that was asked.
I might just add to that one in a little bit. Sometimes this split of regulation between capital markets and central banking can be an issue. And a good case was Nigeria, where the capital market regulator allowed the brokers to offer margin financing. And most of the margin financing was supported by collateral given back to banks. And lo and behold, the index rose dramatically. It was all the bank shares that went up in price because all the margin lending was to clients to buy the bank shares. Those shares were re-collateralised back to the bank. The central bank in Nigeria sacked the management and the boards of 7 or 8 banks, completely replaced them, and they had a major crisis. The stock market fell 80%, the collateral became worthless, and they had to recapitalise the banks, and government had to step in to do that process. But that's a risk that crept up on them, and they crept up on them because 2 different regulators were looking at different aspects of the risk. The capital markets regulator was happy. The banking regulator was happy until the 2 met each other.
Yeah, I will say that's an issue, is to get them together. And as I say, you've got some countries where you have a unified regulator, certainly Canada, Australia, Indonesia has too, but in fact, in most countries, that doesn't happen. Bhutan, the Royal Monetary Authority looks after, all the 2 insurance companies and I don't know how many pension funds. But in many cases, you've got insurance commission, you've got pension people, you've got the central bank, you've got, the central bank thinks that they know everything, and they don't want to talk to anybody because they just tell you what to do, and you listen. So what we try to do is to get regulatory colleges. There's so much interface now, certainly in the insurance industry, between the banks, bank assurance, and so on, and the pensions are also involved in, if they're funded pensions, then you've got to worry about sort of stuff that David worries about, and so on and so forth. So what we try to encourage is memorandum of understanding, regulatory colleges, so that the regulators of the various sectors come together occasionally and look at the common problems, look at this sort of again it's a sort of an enterprise risk management approach on a national basis, rather than everybody working in silos and working at cross purposes. Try to get people to come together. It's not easy, and I think one of the problems that David and I face is that you don't even know if it's successful. You go in there, you get your project, you work with the World Bank or the Asian Development Bank, and then occasionally you go back. I've been back to Bangladesh and Bhutan several times, but in many cases you do it once, and does it work? So, in fact, somebody asked me that, I think, when we were having coffee, what is the outcome of all your projects? And, very sadly, I don't know. Did I do, does it sit on a shelf, gathering dust? I think in many cases it does. So it's a bit tragic, actually.
Thanks very much. There are more questions, but we might push them to the end because they cover commonality between both presentations. So thanks again for your presentation. So next presentation.